Steve Brice, the Chief Investment Officer at Standard Chartered Wealth Management, and he's back now with us. Steve, welcome back to the show. You were telling us how you're overweight on India, but amidst an environment where most global central banks are raising rates, right? There are so many of them meeting this week. Do you think risky assets like equities may take a back seat? And in that context, would it make sense for investors to pause on their on deploying their funds for the moment?
So if we're looking from a global perspective, obviously, the environment is still highly uncertain. I think if we're looking certainly at the macro news flow and the concerns on inflation and central bank policies, clearly there's a significant concern globally about the outlook for economies and whether we're going to see a recession over the coming 12 months. I mean, we've got an assessment that we'll see at least a 50% chance of recession in the US over the coming 12 months. So from that perspective, it is a pretty difficult environment. Now, what we've seen on from a S&P 500 is obviously, we've seen some weakness in recent times coming through. But actually, if you look at the options market volatility, that didn't really spike that much last week, despite obviously that 4% down day that we saw midweek. And also, if you look at the skew of the put to call volatility spread, that is suggesting that actually people are not that concerned. So maybe a lot of the weak hands are already out of the market. So on balance, the news flow is likely to remain negative. Obviously, the FOMC meeting this week is going to be really important. But maybe the markets really needs some really bad news to take another leg lower from here. So maybe just having a decent diversified allocation, adding on weakness is probably the best way for most investors.
Steve, do you think this is, yields are going higher, equities are lower, commodities are lower? This is largely a dollar supportive regime once again. The DXY index has been knocking just at that 110 level, failing to break through it. That's an important channel through which there is, for emerging markets, basically, whether there is a bit of risk on or risk off. What's your sense there? Dollar.
Yeah, so I mean, and actually the causality is two-way as well, because the stronger dollar generally is bad for asset markets, generally, obviously for emerging markets. So you're getting a bit of this feedback loop going. Obviously, at some point, something that can't go on forever will change, but the momentum does seem to be pretty in favor of the dollar. And the last week's inflation print obviously helped support the dollar as well. So over the next 1 to 3 months, the dollar is likely to find good support and track gradually higher. On a longer-term basis, we still think the dollar will peak out, but the things in place for that, we need to see the Feds pivot away from this aggressive tightening stance, and then we can see the other central banks around the world continue to tighten to sort of undermine the dollar. But as I say, I don't think we're there yet.
Okay, so you said that it requires some really bad news for the markets to see another leg lower, which means that perhaps we may have, priced in a lot of the bad news already. If that is the case, how do you structure your investments from here on? Is India your most preferred market? What's the pecking order now? And is this a good time to be buying?
Yeah, so what we've been doing so far is generally de-risking our portfolios as we've gone through the year. So we downgraded equities earlier in the year. We've now upgraded investment grade at the cost of high yield in the credit space. We do think this is not the time to be risking everything and putting everything on the line, so not playing the high beta plays. But within that, we do see a different story within Asia. And whereas the central banks are tightening very aggressively, for instance, in the US and in Europe, China, we see them as easing policy and continuing down that easing path that ultimately will support the Chinese stock market and allow it to outperform. And then obviously India, you're looking for areas that have more resilient growth. And India certainly fits into that bucket. So within India, we're overweight financials, industrials, and consumer discretionary, which we think can leverage that growth and be sort of in the pro-cyclical area at a time that globally, actually, that's not a place to be, but maybe for India it is.
All right, Steve, it's a pleasure. Thank you very much for that perspective. Appreciate you joining in us in the program as always. Thanks.